can affect your cash flow. Depreciation can turn a negatively geared property into a positively geared property, and that makes a big difference. So basically, when you get a depreciation schedule, what we tell you can claim reduces your taxable income. So if you're paying tax on $100,000, right, and we give you a report that says you can claim $10,000 in year one, you should only be paying tax on $90,000. And the good news is that $10,000 is what's called a non-cash deduction. It's the only deduction that you'll get on your investment property that you don't physically pay out for.
Welcome to Get Invested on the Property Hub podcast channel, the leading weekly show for Australians who want to learn how to unlock their full self, health and wealth potential. I'm your host, Bushy Martin, and each week I go deep with the best investors, experts, leaders and founders to find out what it takes to break free from the grind, discover freedom and to live by design. Subscribe now and join me and get invested in the life that you really want. Let's get started.
Hi, Freedom Fighters. Are you worried about how you can continue to afford to hold your investment properties given the continuously increasing costs of just about everything? Or if you're thinking about investing in property or securing another property, are you concerned that it's all going to cost too much and hamstring your lifestyle because you fear that it's going to burn a big hole in your pocket as it eats it into your hard-earned salary and savings? And what's the thing that makes or breaks the sustainability of the journey for long-term investors? Well, no surprise, it's ongoing cash flow affordability. Affordability is the one thing that you really need to consider, manage, and control if you're serious about lasting the distance over the years to enjoy the fruit of full capital growth. So, do you know how much your investment property actually costs you per week in year 1, 3, 5, 10 and beyond, once every cost involved in both buying and holding your property is concerned? If you don't, you're setting yourself up to fail, because it's cash flow affordability that will make or break your long-term investment horizon. So how can you make investment property affordable to hold long-term while it increases in value without having to live on canned spag and dog food in the meantime? Well, this is something that we've touched on in the past here on Get Invested, and it's important to your sustainable success that it's worth reinforcing. Because the answer all revolves around clever structuring of your cash flow affordability. And it's a critical thing that very few property investors spend any time thinking about or even working out properly. Most will-be investors just look at the rent coming in and the loan repayments going out to determine if they think a property is affordable. But this simplistic and misleading approach misses the magic of successful property investment. And I think it's one of the reasons that over 54% of first-time investors sell their property within the first 5 years because they haven't thought closely enough about the strategies and structures required to minimise the ongoing cost of holding their property while it actually increases in value. If you've been listening to me for any length of time, you'll know that I believe that true sustainable success and exponential growth in anything is a minimum of a 15-year journey, particularly in property, where you need to hold a property for at least this long to go through a full property cycle and enjoy the capital growth that results. So the key and often forgotten question that most investors fail to ask and then solve is, how do I make my investment property affordable to hold each and every year? And it's no surprise that given today's returning guests, that one of the biggest potential contributors to your ongoing affordability is depreciation. So what is depreciation? Well, as you're about to hear from today's depreciation expert, tax depreciation is a tax deduction claim for the natural wear and tear of an income-producing building asset over time, like property. And it's generally the second biggest tax deduction for property investors outside of loan interest. Now, it's essentially a tax-free kick. You get to claim a cost that you haven't actually paid against your taxable income. And while it's not the reason to invest in property, tax depreciation is certainly a significant way to improve your cash flow affordability. How? Well, let me give you a quick example. Let's say you spend $500,000 on an investment property. If it's an existing or old property where tax depreciation no longer applies, then it's likely that the property is going to cost you several $100s a week once all of the costs associated with buying and holding the property are taken into account. However, if you spend the same $500,000 on a new build investment property, a just built property, or or undertake significant renovations and upgrades on an existing property after you purchase it, it's not uncommon to be able to take advantage of anywhere between 30 to 50 grand a year in total claimable deductions, including substantial depreciation for the capital value of the building, together with fixtures, fittings and equipment over 10 years or so, which our guest will explain in more detail. And when applied to your income, this can keep anywhere between 8 to 15 odd grand a year of your hard-earned money in your pocket in the early years, rather than going to the tax office. So here's the secret sauce that we've adopted to maximise the ongoing cash flow affordability of our investment properties. We've just built rather than bought new properties using tenants in common provisions to slant the ownership in the favour of the higher income earner, and got depreciation schedules done by quantity surveyors who actually specialise in them, because technically normal accountants aren't actually qualified to prepare tax depreciation schedule reports, and then employed accountant orchestrated withholding tax variations to get the 8 to 15 grand extra incrementally in our pays, rather than wait until the end of the year to get a lump sum tax return, which means we're carrying the cost in the meantime. Now, this winning combination puts an extra $150 to $230 odd a week back in your pocket each and every week, and can potentially use negative gearing to create a cash flow neutral or slightly positive cash flow property. In other words, the just built, new built or significantly renovated property has the potential to put extra money in your pocket every week, whereas an old existing property is likely to be sucking several $100s a week out of your pocket. And this regular extra cash flow injection can be ploughed into paying off your home loan years earlier and save you hundreds of thousands of dollars in home loan interest repayments. It's this integrated combination of clever tactics like this and a myriad of others, because the devil's always in the detail, that can transform a negatively geared high-cost and high-stress investment property into an affordable cash flow no-stress asset that effectively looks after itself while it's growing in value and doesn't impact much on your savings or your lifestyle along the journey, particularly when tax-deductible rainy day reserve equity loan funds are incorporated in your finance structuring. Now, I'm not suggesting that you race out and build your next investment property in the current climate where the construction industry continues to be challenged and it's very difficult to control and fix costs, build times and quality. But as consistency and competitiveness returns into the building arena over the next couple of years, it's then going to be well worth investigating. So watch this space. Now, I've also got to say that I'm not an accountant or tax agent, so I'm not qualified to give financial advice on any of this. So everything we talk about here is just general information, and you need to talk to a property specialist accountant to confirm what actually works and is right for you. But to get started, if depreciation optimization and cash flow affordability improvements are of interest to you, and you'd like to explore how you can transform your current property cash flow headaches into more affordable assets, or have any other issues that are holding you back, feel free to book in with me for a personal solution session by going to knowhowproperty.com.au and hitting the purple book appointment button in the right-hand corner of the homepage, and then selecting the personal solution session option. Or just click the link in the show notes and we'll spend a full hour exploring your best options. Now, to further whet your appetites and to dig deeper into appreciating depreciation benefits as another underutilised weapon in your investment armoury, we're joined again by one of the country's leading quantity surveyors who specialises in producing tax depreciation schedules, and that's Tyron Hyde, the CEO of Washington Brown. As you heard last week, when he shared his personal investment journey with the support and mentorship of Australia's wealthiest property developer and investor, high-rise Harry Trukaboff, Ty is also a fellow author and podcast host. So welcome back, and let's get invested, Ty.
Thank you. Thanks so much for having me on again.
So I want to jump straight into it, and I guess where I always like to start with these conversations is, from your years of experience, what common mistakes do you see investors making, particularly when it comes to depreciation?
I guess the first thing is not getting a depreciation schedule. I'd say 99% of property investors that can benefit from depreciation. There are cases now, because the laws have changed recently, where there are some properties that will no longer benefit you. So if your property is built before 1987 and have no renovations on it, which is pretty rare, then there's nothing we can do anymore, because you can't claim the ovens and the dishwashers anymore, stuff like that, the plant equipment. The other common mistake I see, and I've actually been guilty of this myself, is to get a depreciation schedule. And I did this for a fit out. So say you've got a fit out and you've got the desks and chairs within that within that fit out, but you've removed them, you've changed it. But 3 years down the line, I still say that they're in the depreciation schedule. So when you remove those items, you should be writing off the balance of whatever was left there. So so I would annually check as a property investor, are the things that I'm claiming still there? Because if they're not, well, maybe you get an outright deduction for it. So that's the one thing I'd advise people to look at.
Yeah, 100% agree. Now, I guess to sort of wind the clock back a little bit here, I'd love for you to just talk about the sort of fundamentals of depreciation in terms of what you can and can't do with depreciation on residential property, so that those who are new to this and are just coming into it get a better understanding of what it all means and where the opportunity is.
I think that's a good start. Okay, so firstly, you as a property investor, just like you can claim as a tradie, you can claim the wear and tear of a ute against your taxable income. As a property investor, you can claim the wear and tear of a property against your taxable income. Now, there's two types of allowances that we're talking about here. One is called the Division 43, which is the building allowance, which is the structure. This is the bricks, the concrete, the roof, the windows. This stuff's going to wear longer than what's called the plant equipment, which is the ovens and dishwashers. So it makes sense. Bricks are going to last longer than an oven, right? And so the government has worked out that they should be in two different categories. And so as quantity surveyors, what we do is we work out what the proportion of the structure is. It might be, say, 85% of a construction cost. And you as an investor get to claim that at a flat rate, 2.5% of the original construction cost per annum. So if it probably costs 200 grand, you would get, wait a second, you would get 5 grand per annum. Okay. The other part is the plant equipment. And we go through, and if it's probably brand new, because it has to be brand new now, residential, you claim the oven, the dishwasher, the blinds, all at varying rates depending upon the item. And so we split that into the report.
Yeah.
All that stuff, a carpet. So we split all those items out of the build cost and put them into individual categories, and the rest goes into a lump sum called the building allowance, and that gets claimed at 2.5% per annum of the original construction costs. Right?
I love that.
You buy property.
Yeah, sorry. One of the examples I often use, Tyler, to make it really simple for people to get is if the mobile phone that I've got in my hand, if I shake it, what's left in my hand is the capital cost of the property, and that you can write up at 2.5% for 40 odd years, I think it is. What falls out of it, the fixtures, fittings, and equipment have different lifespans, and we're written off depending on the rules and regulations around that to come up with the ultimate impact. So yeah, no, that's great. That really makes it pretty clear, I think, in what you've just.
Yeah, I might steal that scenario. Thank you, Bushy. I'll claim it as my own. Claim it, get it?
You're free, mate.
Yeah, I like that scenario. Thank you.
No, so sort of moving on from there then, because I think it's a bit of a hidden secret, depreciation, that many people just don't get their heads around enough. How, from your perspective, given you've been up to the eyeballs in it for a long time now, how important is depreciation to property investment outcomes, as you see it, particularly with residential property?
Well, I think it's a lot more well known. When I started in this industry, I used to it was like beating a drum to let people know when no one was doing it. I used to drive to development sites and say, "Hey, Mr. Developer, here's this free report I'll give you, and hopefully if someone buys a property off you, they can come to me." Right? That's how I started the industry. So I'm actually what's called a fellow of the AIQS, which is like as the highest you can get because of services to the industry. I think the F stands for friggin' old these days, Bushy, but I'll take fellow. And so, look, it is very important, but people have got a lot more know about a lot more now. I think if you don't know about depreciation, you really should be getting some advice about it because it can affect your cash flow. Depreciation can turn a negatively geared property into a positively geared property, and that makes a big difference. So basically, when you get a depreciation schedule, what we tell you can claim reduces your taxable income. So if you're paying tax on $100,000, right? And we give you a report that says you can claim $10,000 in year one, you should only be paying tax on $90,000. And the good news is that $10,000 is what's called a non-cash deduction. It's the only deduction that you'll get on your investment property that you don't physically pay out for. It's already in the property when you buy it, right? All you need is someone like Washington Brown to tell you what that figure is. So if you don't claim it, you're missing out on deductions, and it helps your cash flow. So it is a vital part of the property investment equation, if you ask me.
100%. And just take that example. It's a bit of a free kick from where I see it for an investor, because let's take that 10 grand a year that normally you would get back in a lump sum at the end of the year in your tax return. Now, if you take it to the next level and you've got a good accountant and you're an employee, that you can then craft a PAYG withholding tax variation, then rather than carry the cost of the property for the full 12 months and then get that lump back, you can get that an increment of that back every pay. Now, at 10 grand a year is about $190 something a week. If you're getting $190 a week back in your pay packet, which is smoothing the cost of the property, and you're pounding that into your offset account against your home loan, not only you're smoothing the cash flow, but you're helping to reduce the interest and pay your home loan off far quicker than what you otherwise would by taking advantage of that depreciation and then leveraging it in other ways to actually achieve and improve the overall position. So I love that, mate. Now, in our conversation last week, you talked about how depreciation laws have started to change the way QS firms operate. Can you give us a bit more detail around that and what that means?
What happened was in 2017, and by the way, I agree with you on the income tax variation. I think that's far more underutilized than depreciation schedules, and it is a great option. But in terms of the laws changing, what happened was in 2017, the government, out of the blue on budget night, said if you're buying a residential property, a second-hand residential property, you can no longer immediately claim. You can't claim any of the ovens, dishwashers, blinds, etc., even if they're 1 day old. So, which is kind of bizarre, because the government says your carpet's going to last 10 years, but if I sell it to you after 1 day, you can't claim that anymore. And it even gets more bizarre because it's different in commercial, right? So commercial property, you can buy a 100-year-old factory and still claim a really old air conditioning's in there, or a motorized garage door opener, right? So they only changed it for residential, and also they didn't change it for brand new property. So we've got all these varying different laws now. So if it's brand new, you can, in residential, you can still claim the ovens and dishwashers. It's just when it comes to second hand. So that certainly changed the way that we operated, because a lot of the times now, we might not have to inspect the property because we've already got the cost. So if you're buying a second-hand property that's 1 year old from, say, Meriton, who we talked about last week, I've got all the costs. Me going there is not going to change the original construction cost. We used to go out there all the time and re-inspect and revalue all the plant equipment, etc. But it's all irrelevant now. So what we do is we actually look at the property first and say, well, in this case, we might not have to inspect your property because there's no benefit. And we pass that saving on to the client. But if it's commercial industrial, where we can do that, we inspect all those. But sometimes, if I've got all the costs on the property, me going to see that oven that's 6 months old, even though I've been given all the costs, isn't going to help. It's just going to charge the client money. So we say, well, we don't need to inspect that one. So that's how it has changed the industry somewhat, the law changes.
Yeah, I understand. So it's always a moving feast in that area. So I guess something that I know everyone will be wanting to wire into is, can you sort of share your best tips to improve depreciation outcomes in terms of what property investors should be thinking about when they're looking to invest in or structure a property?
Firstly, I'd say that the depreciation shouldn't be the number one goal in buying a property. I would say it is more the icing on the cake. I would think that people should know what the difference between a brand new property now, residential, and a second-hand, and not getting because a lot of people still don't know. They get a big surprise when we say, no, you can't claim. Because to put it in perspective, the difference in what the changes have made. Let's say you were to buy a brand new property now for $800,000. Your first year property depreciation claim might be anywhere from $15,000 to $20,000, depending upon the quality of it. Right, quite high. Yeah. The moment that's 1 day old, you'd be lucky to get $5,000 or $6,000 per annum, because it takes away the law changes have taken away the early year deductions. After about 10 years, it's exactly the same, because all you've got left is the structure of the building. Yeah. But it's the early years, it's when a lot of property investors need those deductions to make it work that have been taken away by the government. So I think people need to know that the difference. And look, recently I surveyed a lot of clients. I just thought, wonder how many people know this. And I reckon 3 out of 100 knew that there'd been any changes in second-hand depreciation allowances, which is surprising because they've been around for 6 years now. But I guess it is because a lot of people don't buy second-hand property for the depreciation allowances. They buy a lot of new property before it, but they're not really going in there going, oh, look, I can't wait to get that $4,000 building allowance deduction, right? And I think it's right. They shouldn't be basing upon that. But it is the ice. It's ice on the cake, and it does make your property more affordable during the journey of your property investment journey, I guess.
And I think that's the key thing, because if we're investing for 10, 15 years or more, and yes, we're focusing on growth, it needs to be affordable growth, though, because if the property's burning a massive hole in your pocket and you can't afford to hang on to it and you're living on dog food and baked beans for the period to actually get to the end of the journey, then you're probably not likely to do it, and it's not likely to be sustainable. So if you can take the advantage of depreciation and smooth that cash flow so that the property is affordable, and we do calculations on this all the time, Ty. We've got some software, and we're not accountants, we're not QSs, but based on experience, we can make some initial allowances that at least give investors a sense. And if you buy an existing property that only has the capital depreciation left on it, versus a new build where you get the stamp duty and you get the depreciation benefits and a whole bunch of other stuff comes in, the holding costs can go from $300 or $400 a week down to a bit over $100 a week. Now that's a massive difference in terms of that ongoing cash flowing of the property to actually be able to enjoy the growth over that period. So I think that's a big benefit that depreciation adds to the mix from that affordability perspective. Are there any other things that we haven't talked about in depreciation that either aspiring investors or existing investors need to be aware of, Ty?
Well, there's one thing you just talked about, your cash flow analysis. On our website, there is a depreciation calculator, and it took a long time to develop. It's the only one on the market that you can sit there and actually enter in a purchase price of the property. So every other calculator out there, you need to know the area of the property. Now, the area of the property can be quite tricky to know. Are you talking about the internal area? You're talking about the garage area? You're talking about this common area, right? Not many people know those things. But our calculator, you can enter in a purchase price and say, I want to buy $800,000 property built in this. And what it does is, I guess we were using AI before AI was a thing, because we put all our results into the property. And we've done 300,000 reports pushing. We put all the results into a big data pool, and it grabs the nearest matches of those properties and spits out what the depreciation was on those existing properties, right?
Yeah.
So if you're sitting there with your clients, because people know the purchase price, not everyone knows the area, but everyone knows what they're either going to pay for a property roughly or what they have just paid. So they can get a quick estimate that way. So it's a really good tool. We know people to sit there like financial advisors and just sit there and use our data all the time, which we're happy to do, because we're hopefully when they want to report, I use the wash and round calculator, and they come to us that way.
Yeah, I love that. Well, we've really only scratched the surface, and I know you're under a bit of time pressure today, so we'll leave the door open to continue this conversation at a later point. And you might want to share the hat you just put on, that.
Just put a hat on if you're listening to this, which says, make depreciation great again. I was on a podcast recently, and the host said to me, he goes, Tyron, what you do is, no offense, but it's really boring. I'm like, oh, no offense taken. It's what I've done all my life. It's my life passion. And so I got these hats made up, bushy. It says, make depreciation great again. And I want to get them on at least the podcast once. And,
you need to send me one of those now, mate, because I'm a great baseball cap wearer. So I'll be a proud wearer of one of those caps, mate.
Yeah,
I want to jump into the second bushfire round, but
okay.
One, and before we finish up, what's your favourite quote and why?
Well, the last quote. Well, there's two quotes. One is the more I practice, the luckier I get, by Gary Player, which was related to golf, right? From a personal point of view, it hasn't worked. The more I practice, I don't seem to get any better. Maybe I should practice more. But I do like Harry's quote, the secret to his success. If you haven't heard that one, please go back and listen to it. But I love that. Right? I think it really is a metaphor for life and for business, and just to ignore the noise. I thought that was so, not simple, but it does help having $26 billion to be patient. But I thought that was such an apt quote. So those two are my two favorite quotes.
Love that. In the literary field, apart from your books, which we'll talk about in a second, What's the top book that you'd recommend we read and why?
Well, again, we mentioned it as the first one, but I loved Atomic Habits. I think for people that haven't read it, it's a book about creating good habits in your life and keeping them. And I'll give it 2 examples. One is to remove Facebook and Instagram off your phone and just use them on a desktop. And you find you'll get an extra hour, 2 hours a day. And you know what Facebook does? When you go on your desktop, they serve you up the good stuff, right? The first 4 are really good, and then it goes into the ads because they want you to come back. They're like I don't know, internet drug dealers where they give you the first one free and hope you come back. So that really works. The other one he talked about in the book was if you want to go training in the morning, don't wake up at 5 in the morning and find your gym gear. Put it at the front door before you go to bed. You're more likely to get up and go for that run if it's at the front door. And it's true, it works. So that's why, I think not just creating great habits, but how to keep them is the key message from that book. And I really enjoyed that book.
And love it. And that is the perfect segue into the last of these questions, Ty, which is what's a personal habit, rewarding ritual or daily discipline that you've employed that's contributed the most to your success today?
Well, that might make you laugh, this one, but every morning I wake up and I make my wife a coffee. And it's become such a ritual now that it just has to happen. And I think, this saying, happy wife, happy life, there's certainly something in it, but it starts the day off well that we're talking and, we just have a coffee together every morning. And that's a good ritual that we've got into. And when I'm away, she misses it because, I think I know how to use the machine better, but she because it's one of those really complicated ones. But that's a good ritual that it gets us talking in the morning, and we love. She's got a Italian background. I love coffee. She loves coffee. So
yeah, I'm right with you there, mate. So I'm looking forward to catching up with the coffee at some stage. And final question: if I ask you to get invested, what does that mean to you?
Good question. I like this question. I like a lot of the questions, but I particularly like this one. And for me, get invested in yourself. Get invested in your education to go a long way in your success. And I think there's so many options out there now. It could be I was going to answer this in 2 ways, but I think get invested in yourself is one. The other one is just do it. But get invested in yourself, learn, educate yourself, whether it be podcasts, read books, but also I'd also say enact. Don't procrastinate. Sometimes time can actually turn a bit of a bad investment into a good investment if you do have the incredible patience, right? But I prefer to time the market and have time in the market like Harry does, but not everyone can do that. So you get invested firstly would mean to educate yourself is what I always say.
Love that, mate. For those that have really resonated with your message, how can we find out more and get more involved with you, mate?
Oh, thanks. All right, well, as I mentioned a couple of times here, I have got a podcast which I want to get you on called 10 with Ty. If anyone listens to other podcasts, there's some really good ones there. They're not just property people. I've got some share people on there, entrepreneur, Dale Beaumont. There's some really cool. And that's why I think everyone's coming at it from a different angle. And I'm leaving this for my daughter, so there is a bit of a legacy that I want to leave there. If anyone listens to that one of the podcasts and leaves a review and sends me an email to tyron@washingtonbrown.com.au, tyron@washingtonbrown.com.au, leaves a review, I'll send you 2 books. Free of charge. I'll even pay the postage. One is called Keep Claiming It, which is my book about depreciation, property investment. And the other one is called Secrets of Property Millionaires Exposed. And that's where about 12 of us have written a chapter about property investing. And so they're both good reads. So actually, this Keep Claiming It became a bestseller, Bushy.
Yeah, I love that.
That to become a bestseller in this country, you have to sell 7,000 books. Now, it's not easy to sell 7,000 books about property depreciation. The fact that my mother bought 5,000 is completely irrelevant, right? But I did actually become a bestseller. So there's an offer for anyone if they want to read the books.
Absolutely. Well, you probably see my email amongst them, mate, because I'm keen to dive in. I'm an avid reader. I've always got about 5 books on the go. So I look forward to having read that. And look, mate, I really want to thank you again for taking the time to refresh us on all of your wealth of wisdom around the benefits of depreciation and the importance of surrounding yourself with great people that you can learn from over the last 2 episodes. So thanks again, and thanks for getting invested.
Been an absolute honour. Thank you.
Thanks for tuning in to Get Invested on the Property Hub podcast channel, your home for property investment insights and inspiration. Make sure you subscribe to Property Hub for free. Get your weekly dose of Get Invested inspiration along with every episode of Realty Talk, Australia's top online property show for red-hot property investing news and insights direct from industry leaders and influencers. And finally, I'll see you next time.